Hi folks, welcome to a new episode on That Financial Goal. Today, I'll be touching on a new fintech player called Choc Finance. Sounds yummy, isn't it? Okay, long and short of things, they are offering 4.5% guaranteed daily returns on your first $20,000 and a target of 3.5% on any amount thereafter. In fact, there is no lock-in period, no fees, no hoops. You can withdraw your funds anytime. In fact, if the portfolio doesn't meet the 4.5% target, Choc Finance will top up the difference to ensure that you can enjoy the returns during the qualifying period till 30th June 2024. Hi meh, sure or not? Sounds too good to be true. Surely got some catch or some risk involved? Yes, you are right. So I actually went to do some digging, and here's a summary of what I found on their FAQ website. First things first, who is Choc Finance? Is it a bank? Okay, so according to the website, Choc Finance is not a bank, and therefore, unlike any other banks, it is not insured by the STIG for up to $75,000. Instead, it is a managed account operated by Havenport Investments Private Limited, and Havenport is a holder of capital market services license and an exempt financial advisor regulated by the MAS. So it has a legit license number and is regulated to perform fund management activities and is allowed to deal in capital market products and provide custodial services. So the Choc Finance brand is actually owned by this company called Choc Private Limited, which is a shareholder of Havenport Investments. So it is founded by this guy called Walter, who used to be the founding director of Singlife, where he also served as the group CEO and deputy chairman. His previous stints include that as deputy chairman at Aviva Singlife Holdings and board member of Singlife Philippines. So if you're interested to find out who are the investors of Choc Finance, they include this company called PICXV Partners, previously known as Sequoia, Process, Credit Suisse, GFC and Dara Holdings. So when it comes to new players in the market, I think a lot of us will be very worried whether it is a good product and is this a safe company, right? So what kind of product is this? Is it safe? So while you get to earn potentially a 4.5% per annum return on your first $20,000, kindly note that this is not a fixed deposit, okay? It is also not a cash deposit, nor is it a risk-free investment. Okay, returns are not guaranteed as they are generated through a portfolio of short-term fixed income funds, which is subject to market volatility. So while Choc Finance shared that they will top up the shortfall so that you can earn the targeted returns, in the final T&Cs, they actually have the discretion to change the target return, right? So maybe one day you will not see that it's 4.5%, they can actually drop it to 3.5%. Right? So it is possible to make capital losses, meaning to say that if you put in $20,000, you may not get back the full $20,000. Okay, so the portfolio actually comprises of three major funds. Okay, first fund is actually Dimensional STIG SGD, which actually makes up 60% of the portfolio. So UOBAM United SGD Finance makes up 35%, followed by the Fullerton SGD Cash Funds, which makes up 5% of the entire portfolio. So according to Choc Finance, this may change at the sole discretion of their portfolio manager, and in your Choc app when you log in, you will be able to see the information on each fund and the percentage of money that is allocated to them. Okay guys, let's dive deeper into each of these fixed income funds. Firstly, the Dimensional Global STIG Fixed Income Fund. Okay, STIG stands for Short-Term Investment Grade. So since 60% of our invested funds actually goes into this, let's take a closer look at the key metrics as extracted from their latest fact sheet. In summary, you are mainly looking at 39% allocation to US bonds, a 2.86 years average maturity, and a yield to maturity of 5.19%. And you will notice that there is a 76% allocation to A and BBB bonds. Quite a chunky amount actually goes to those, yeah? So it is actually very interesting to note that only 30% is being allocated to AAA bonds, which is deemed to be the lowest risk according to the credit rating scale. Okay, so if you look at the credit rating scale, guys, BBB bonds, though is an investment grade bond, it is actually deemed to be number 1, medium risk, and number 2, it is only one level above junk. So what does this mean? High risk, high return. Okay, now let's take a look at the second fixed income fund, which is the UOBAM United SGD Fund. Okay, so 35% of our monies are being allocated to this fund, and here are the metrics as of August 2023. So in summary, you are looking at 21% exposure to China, 18% to Singapore, and 11% to South Korea. So you can tell from this matrix that the fund is very much concentrated in Asia, unlike the earlier fund. And in terms of average maturity, this fund has a 1.2 years, which is slightly shorter than the dimensional STIG fund. Yield to maturity is 4.64%, and 41% is being allocated to the financial sector. Lastly, let's take a look at the Fullerton SGD Cash Fund, where 5% of our monies goes into this. Okay, maybe some of you are familiar with this. If so, you can skip this section. But otherwise, I'll go through it really quickly. So this is one of the most popular low-risk money market fund you can find in the market. It has an AUM of 2.6 billion, okay, meaning asset under management. So as you can see, 86.4% of your money is being deposited into less than 4 weeks deposits. Okay, so it has an average yield of 3.5 to 3.8%. So it's really more on the safe side, yeah? Okay guys, in very layman terms, okay, throw away all your financial jargons and the complexity of this product, right? To get high interest, high returns on your funds, your money, right? There's only 2 ways to go about, right? Either you lock in your funds for a longer period, or number 2, you take in higher credit risk, because high risk equals high return, and we can already almost see this is what Chocolate Finance is trying to do here, right? 95% is being allocated to slightly longer tenors, 1 to 2 years duration bonds, and only 5% is being allocated to the Fullerton SGD Cash Funds, which is the shorter and safer short-term money market funds. So they are also taking on slightly higher credit risk by putting funds in A or BBB bonds. So I think by now you'll be asking me, so are there any catches? What can go wrong? What's the worst case scenario if you buy this fund, right? Before I go into that, okay guys, I would just like to highlight that I am not a certified financial advisor. If you intend to make any purchase, do any investment, please tolong please go and do your due diligence check. Go and read all the FAQ and then be comfortable in whether you want to invest in this, okay? Ask a lot of questions, okay? First and foremost, recognize that there is an inverse relationship between bond prices and interest rates. What does this mean? Okay, it means that if interest rates goes up, your bond prices goes down, right? So meaning to say, the value of the underlying fixed income funds purchased by Chocolate Finance will drop, and this can potentially impact your portfolio. I think we all know that we are living in very high interest rates environment, but we are probably near the tail end of the rate hike cycle. Probably one more rate hike, then we're gonna stay at high interest rates environment, and slowly it will dip down. So the impact from the rising interest rates may not be that big on the portfolio. But then again, we do live in crazy times today, right? Who knows what interest rates or where interest rates will be heading to, right? Okay, secondly, if you ask me what can go wrong, as an investor, right? Okay, I always pray very hard. I popi that the underlying asset don't go into credit default. Okay, don't forget, Chocolate Finance actually invest your funds into dimensional STIG fund, which has 45% being invested in BBB bonds. Okay, if some of which starts to default, it's really not impossible to see capital losses. So worst case scenario, if you ask me, right, is when you have these two things happening simultaneously. Okay, number 1, rising interest rates environment. Number 2, credit default happens. When these two happen simultaneously, I think the next natural reaction is that customers will start to withdraw their funds at Chocolate Finance. Remember, Chocolate Finance say no hoops, no penalty for withdrawal, and no lock-in period. This means that it's very easy for customers to withdraw, and when everybody starts to withdraw, that is when you have to be very careful, okay? You have to ask yourself, will we see another repeat of the Silicon Valley Bank? Okay, will Chocolate Finance be forced to liquidate their underlying fixed income funds at market price? Remember, because in rising interest rates environment, bond prices comes down. Okay, so this means that they have to realize capital losses, and this will impact their balance sheets. But if they have sufficient equity and cash on hand being set aside for funds withdrawal that can help to cushion the impact of mass withdrawal, then it's a different story. Yeah, and bear in mind, remember, Chocolate Finance also shared that they will top up any shortfall on both losses incurred on capital and the target return, just so that you as an investor can earn that 4.5% per annum. So does this mean a faster depletion on their equity and cash reserves? Okay, so I tried to do a little bit of digging. There's really little information on their startup funds or their equity base. According to Crunchbase, okay, they actually had a Series A funding of US $19 million raised in August 2022. Okay, my final thoughts on Chocolate Finance. Okay, I think on surface, it really seems like a fantastic, sweet deal, right? 4.5%, no hoops, no withdrawals. It really sounds great. Okay, I think in the early days of this product, it will actually be fine as long as new monies continue to roll in, and so long as the portfolio continues to generate returns to meet and cover our expected target return of 4.5%. Okay, but I personally think that this sweet deal may potentially crack, okay, and start to taste bitter if credit default happens and interest rates starts to rise and investors starts to pull out their funds simultaneously. Okay, so just bear in mind, okay, of these things, and that your account is not safe from capital losses. It's not a fixed deposit. You have no guaranteed returns. Okay, so you kind of have to really like balance between the risk and return over here. Okay, then the question will now ultimately boil down to whether Chocolate Finance has sufficient equity funding or cash holdings to cover withdrawals when you wish to do so, right? But just like in the worst case scenario where I highlighted that, well, if everyone starts to pull their funds out, right? So do they have that sufficient equity funding or not? For me, my thoughts are like, you know, the highest FD T-bills are paying in the range of 3.4% to 3.73%, right? If the upside is only going to be this little of 0.8% to 1% more, I personally just rather park my funds in FDs or T-bill and have a really nice and peaceful sleep, okay? Because this is kind of like my hard-earned money, right? Okay, disclaimer guys, I do not have any funds invested in Chocolate Finance, but if you wish to sign up, I did see on their website that you have to join the wait list. Okay, so just make sure that you are 18 years old and above. So what do you guys think? Is this a sweet or bitter chocolate deal for you? Let me know in the comments below. And once again, this is That Financial Go checking out. If you can, do help to hit the like and subscribe button.